Here's our quick roadmap for today to help you secure those top marks. We'll breeze through the trial balance basics, bust a massive misconception, outline the core exam objectives, reveal the illusion of accuracy, and finally look at how these errors impact your final accounts.
Okay, Section 1, Trial Balance Basics. Just as a quick refresher, once you've posted your accounts in the ledger, your next step, which is the third phase of the accounting process, is prepping the trial balance. It basically shows your debit and credit balances on a particular date. Now, following the good old double entry system, whatever goes on the debit side always has to equal what goes on the credit side. So naturally, the totals of your debit balances literally must equal the total of your credit balances. Pretty straightforward, right?
Moving on to Section 2, Statement, not an account.
Grab your notepads because this right here is where so many students lose easy multiple choice points. Never forget this fundamental rule. The trial balance is just a statement. It is not an account. An account is where the actual double entry accounting magic happens. The trial balance, well, it's just a summary list pulled directly from those ledgers. It doesn't actually follow double entry rules itself, it's simply reporting on the results of them. Getting this distinction locked in your head is a surefire way to grab free points on test day.
All right, Section 3, Core Exam Objectives. So if it's just a statement, what's the actual point? Well, there are three main goals here. First, it acts like a mathematical spell checker to establish if your posting and other processes have any arithmetical errors. Second, it serves as a nice, clean summary of that dense, messy ledger you've been working on. You really only need to dig back into the ledger when you need specific details. And third, it forms the whole foundation for preparing your final financial statements. They are normally built directly off an agreed trial balance.
Now for Section 4, the illusion of accuracy. Pay attention, because this is absolutely the most critical concept to grasp for your exams. The textbook explicitly warns us that the agreement of a trial balance is not a conclusive proof of accuracy. There's this really dangerous illusion of perfection when the numbers match. I mean, sure, it gives you reasonable confidence that your work is free from simple clerical math errors, but certain errors of principle and compensating errors can totally slip by undetected. Let's look at exactly what these invisible errors look like. Undetected error number 1 is complete omission. Say a transaction just hasn't been entered at all in the journal. Well, your trial balance will still perfectly tally because you didn't record a debit and you didn't record the corresponding credit. The total balance isn't thrown off at all. The trial balance is literally blind to this missing information.
Then we have error number 2, writing the wrong amount. If you write down an incorrect amount, but you put that exact same incorrect number in both the debit and credit columns, the math still balances out perfectly. The arithmetic checks out, entirely hiding your mistake from the trial balance. It's sneaky.
Okay, error number 3 happens when you mention a completely wrong account in the journal. Look, as long as a debit amount went to the debit side and a credit amount went to the credit side, the trial balance does not care if you use the right specific asset or expense account. This is called an error of principle, and it slips right past our little arithmetic check.
Finally, error number 4. There are specific ledger posting errors that will totally trick you. If an entry just isn't posted at all in the ledger, or actually if it's posted twice, the debits and credits will still equally offset each other. Your totals will agree, and you'll be blissfully unaware of the blunder. So the absolute key takeaway here? A tallied trial balance does not mean you can just turn your brain off.
Now, what happens if your trial balance actually doesn't tally, and you're staring at the clock running out of time on your exam to find that math error? You've got to tally it by transferring the difference to what's known as a suspense account. This is merely a temporary account you open just so you can proceed further and prepare your financial statements on time. It just holds the difference until you can properly locate those errors later.
Section 5, Impact on Final Accounts.
Why does missing these hidden errors matter so much? Because the trial balance is the direct basis for your final accounts, so it creates this really dangerous domino effect. If your financial statements are built on a trial balance hiding errors, those statements won't give a true and fair picture of the business transactions. An undetected error flows directly into your profit and loss account, and ultimately, it corrupts the entire integrity of your balance sheet.
So, the next time you finish a practice exam and you catch yourself sighing with relief because your trial balance tallied perfectly, stop and ask yourself, what fatal errors might still be lurking beneath the surface? Always remember to carefully journalize and post your entries right from step 1, because as we've seen, the trial balance will definitely not catch every mistake.
Thanks for joining me for this explainer class. Keep up the great studying, and I will see you next time.